bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 24th, 2026 episode. My guest this week is Peter Lawrence. Peter is Novogradac's Chief Public Policy Officer, and he is based in Washington, D.C. Peter's back on Tax Credit Tuesday to discuss recent developments in housing policy. We're having this podcast now because I thought it was a good time to update our audience on President Trump's 3 housing policy executive orders, one in January and one just a couple of weeks ago. And also, Congress is seeking to pass a bipartisan housing bill. As such, today's podcast is going to be twofold. First, we're going to discuss how the Trump EO's executive orders could affect the development and preservation of affordable housing, with particular attention to the long closing tax credit, but also looking at opportunity zones, new markets tax credit, and historic preservation. And then second, we want to focus on efforts to pass a bipartisan housing bill and how that bill could affect the same stakeholders. Now, for background, the executive orders are something that Trump can simply issue. So those are fairly straightforward in terms of background. However, from a housing policy perspective, housing bill perspective, when we're looking at what Congress is seeking to pass, you really have to start with last year, where the House Financial Services Committee passed a housing bill, a broad policy-based housing bill entitled Housing for the 21st Century Act. It was passed in the Financial Services Committee last year, and then it passed the full House February 9th of this year. Also last year, the Senate Banking Committee passed the Road to Housing Act. Now, the Road to Housing Act was attached to the year-end National Defense Authorization Act before being sent to the House. The House ultimately rejected the Senate-attached housing bill, and ultimately it was removed before passage of the National Defense Authorization Act. Given that, the Senate then had to reconsider their bill, and they did end up passing their bill recently. And in retitling their bill, they merged the name of the two bills together. So now we're dealing with the 21st Century Road to Housing Act. So the 21st Century Road to Housing Act, now having been passed by the full Senate, it does not agree with the House-passed bill. So now the question is, how will the two bills come together, and what is the prognosis? But as noted earlier, Peter and I are going to review that bill and how it could affect affordable housing and other areas of community development where we work. With that as the lead in, we have a lot to discuss. So if you're ready, let's get started. Peter, welcome back to Tax Credit Tuesday.
Thank you very much, Mike. Always appreciate the opportunity.
Well, I appreciate you joining on fairly short notice to discuss housing policy. Normally, we're very focused on tax credit bills and tax bills and things of that nature. This is a little bit broader, but I thought it was important to bring you back so that we could talk about the areas of executive orders that will affect our clients, as well as how the policy aspects of this housing bill could affect our clients, really focusing on in the trenches, how it would affect them. But that being said, before we jump into all of that, this is your 25th appearance on Tax Credit Tuesday, second only to Tony Grapponi. But of course, Tony Grapponi is also a host. So you're number one of non-host appearances. And I won't say how many appearances I've had on Tax Credit Tuesday. Your last appearance was in January, and that's when you provided an update on federal legislation that reflected on 2025 and looked ahead to what might be in store this year. That is a very popular episode, so we'll include a link to that episode in today's show notes. And for the members of our audience who did not see that episode or otherwise haven't seen you on an episode more recently, I wanted you to describe some of the services you provide to Novogradac clients.
Sure thing, Mike. And I always appreciate this opportunity to get on. And maybe one day I'll nip Tony. We'll see. But first and foremost, I want to make sure everyone out there is listening. If you've got a problem with particular federal policy, whether it's a challenge in a particular law, you see a particular regulation or guidance, please reach out to us. We'd be happy to engage to try to address that issue. We work on a variety of different matters. that involve affordable housing. And we've got experience in dealing with those sort of things. Or if you want to research a new proposal and idea, I know Novogradac have helped develop various proposals that could help advance affordable housing community development. So please reach out to me. We'd be happy to talk to you about any engagement there. But another way, if you don't have a particular issue, but you still want to remain informed about what's happening in the key policy areas where Novogradac practices, you should join one of the many working groups. We'll talk about those, but just to give you a highlight of them, we have the Low-Income Housing Tax Credit Working Group, the New Markets Tax Credit Working Group, the Opportunity Zones Working Group, the Renewable Energy Working Group, and the HUD Income Limits Working Group, and the Rental Housing Preservation Work. All of those are centered around various particular matters that convene similar stakeholders that work together to come up with a consensus approach to commenting to various post comment letter opportunities or weigh in with the Congress administration on key issues. So encourage you to reach out to consider joining one of those working groups if you want to stay informed.
Great. Thank you for that, Peter. And I will have your contact information in the show notes for our listeners. So let's start with the 3 executive orders. And I want to start with the 3 executive orders that Trump has issued, because those have been issued, directing various departments to take various actions. So that's active and has effect. The bill obviously is a function of actually being enacted. But obviously, if it does get enacted, and we'll talk in a bit about what you think the chances are, but if it is enacted, then our audience wants to be aware of the key aspects of it so they can react appropriately. But starting with the 3 executive orders, the first EO was issued in January. And broadly speaking, that executive order seeks to limit the institutional ownership of single-family homes. Easy to say, a lot to unpack there. So please describe for our audience, give a brief overview of the executive order.
Right, happy to do that. And just to give a little bit of a context, we've been hearing, and I think we've maybe even brought it up on a podcast or two, the anticipation that the administration was going to come out with executive orders relating to housing. And so the first one we saw was on January 20th, as you mentioned, to focus on one key issue that was particularly pressing. I know this administration's been really focused on trying to incentivize more housing for homeownership. And one key concern that has been raised by some advocates is the increasing use of investors to buy up single-family homes that could be potentially, theoretically, sold to individual home buyers. Some markets, you may see a higher than normal penetration of that, like in Atlanta. Although nationwide, there's not a huge percentage of that, given some concentrations in some markets that and the political saliency. I think one thing remarkable that we see is so much attention on housing and affordable housing issues in Washington, D.C. and the federal government that's leading to all of these actions. And in all of the years I've been in and around this space, like I've never seen this amount of attention on housing before. So in that respect, that's welcome. But, this particular executive order, first of all, I think it's also worth just backing up and saying executive orders aren't laws. They are a direction from the president to the rest of the federal government to take actions, forthcoming actions to try to effectuate and implement policies. And there are certain things that federal agencies can do to disincentivize investors from buying up single family homes. And this is clearly one aspect of what that executive order from January 20th was designed to do. But to a large extent, a lot of it has to also come from Congress. And we'll talk about the bill in more detail later on in the podcast. But that executive order, in many respects, was turned into bill text and potential law in the 21st Century Road to Housing Act. And it seeks to discourage institutional investors from buying homes for homeownership. And in fact says if you do own 350 homes, then you, according to the bill as currently drafted, would be required to sell them to individual home buyers within 7 years. And that's one of the more controversial elements of that one provision in this legislation we're going to talk more about detail, but it's all coming from that was kicked off by that January 20th executive order and represents one of the key priorities administration has in this pending legislation that you referenced, Mike.
So if I work in the low-income housing tax credit universe, and maybe I'm a state allocating agency, maybe I'm a lender, maybe I'm an equity investor, maybe I'm a syndicator, maybe I'm a developer. Tell me why I care about this executive order limiting institutional ownership of single family homes.
Right question. And despite our efforts and our allied efforts, technically speaking, there are some low-income housing tax credit properties that meet that definition of single family, which is under the bill, 1 to 2 units. It's not very common, but you see it often in tribal reservations. You see it sometimes in rural areas. You see it particularly in New England. There's a higher percentage of that. Again, relatively small nationwide and not typically what most people think of when they think of the low-income housing tax credit, but there is no exemption for that. And given how it's constructed, it could affect the ability to use the low-income housing tax credit in that circumstance. And then more broadly, I do think there's a lot of concern amongst many housing industry groups, given how one of the ways we've incentivized new housing supply is through the build-to-rent option, where you have investors and developers develop a whole set of properties, all considered one piece of land and one investment, and conceived as rental housing only. There are some people, they're not able to get a mortgage or they can't afford it. It doesn't fit what they need given work obligations. And so they want to find a single family home to rent. And this is one option that has produced it to a large extent. This provision, if enacted, could present a very serious obstacle to doing that, potentially strongly affecting the build-to-rent option. And some people that use the low-income housing tax credit also do build-to-rent as well, and so it could definitely affect those operations.
No, I totally agree with that. And that's one of the reasons why I know that you're monitoring the various departments' response to the executive order to try to help ensure that institutional ownership of single family homes that are rented to families that are either build to rent rentals or acquisition renovation rentals, that to the extent that low-income tax credits are being used to help finance those homes and those low-income rents, that there's no issue with the quote institutional ownership of single family homes that are being regulated under the low-income tax credit incentive. So that's something that, go ahead.
All right. Be to interrupt you, Mike, but I think one of the aspects we don't think Congress, this was kind of rushed provision in general, and I didn't think they realized how in conflict that provision might be with something like the low-income housing tax credit. As you know, Mike, there's a 30-year long-term use restriction that's encumbered on the property that comes with that. So how that would be reconciled with the directive to sell to individual home buyers, many of whom live in housing credit finance housing, aren't really able to buy homes to a large extent, and you'd be forced to kick them out. How that would you reconcile that given the long-term use restriction? There's lots of conflicts in there, a lot of unintended circumstances that I don't think were fully thought out as this legislation was considered.
Well, there's really 2 points here that are getting merged together. One is the executive order and all of its rules. And as the agencies are coming up with their rules to carry out the executive order, we have to ensure that the rules by the various agencies, Fannie, Freddie, et cetera, don't encroach and harm low-income tax credit developers and the ownership and the ability of investors to invest in those properties. So that's the executive order part. And then there is also the broader bill that we're going to talk about later, where it has more deleterious effects, which we'll talk about in a little more detail. But here I just wanted to emphasize for our audience that there are these 2 areas, and this EO effect on single family home institutional ownership is one that does have the potential to affect the LIHTC community. And we have to ensure that as guidance is issued. There are appropriate carve outs in the rest, so they're not harming the ability of investors to invest in single family homes that are rented and governed by the loan of the tax credit or other incentives. It could be the historic credit. It could be a number of other incentives that have tax credits involved on single family homes being rented. Okay. Now let's go to the two other executive orders. There's two. One, we'll start with the first one that has to do with removing and reducing regulatory barriers to building housing. So that executive order, once again, instructs various departments to take steps to, reduce and remove regulatory barriers. How will that end up impacting tax credit and other affordable housing developers?
Yeah, and this is something we've been also widely anticipating for many months now. We'd seen earlier versions of this executive order being considered, and we are largely thankful for anything that can be used to help reduce the cost of using federal housing programs to build and develop either housing for rent or for home ownership. And this particular executive order does direct key federal agencies involved in housing programs, most notably, of course, HUD, the Department of Congress, Department of Transportation. Transportation has transit-oriented development programs that often impact the financing of housing. The Federal Housing Finance Agency governs, to a large extent, the Fannie Mae, Freddie Mac, and the Federal Home Loan Banks and their efforts to help with housing finance. The Environmental Protection Agency often has key regulations that affect the ability to build homes. The Department of Energy focuses on the various energy related aspects of developing housing. And obviously the USDA, U.S. Department of Agriculture, is key agency governing rural housing programs. And all of these various agencies are directed in this, to streamline existing federal approvals, review the existing federal regulations guides that affect housing construction, and take actions to either reduce or eliminate barriers to home construction. And a couple other specific examples I'll just note is the Advisory Council on Historic Preservation is directed to develop guidance to simplify those preservation reviews to help reduce barriers to using preservation resources for housing. And federal agencies are even directed to provide incentives to state and local governments to reduce barriers, which I think may indirectly help reduce the cost of developing housing in their respective states and localities. Lastly, and one particular thing we at Novogradac are excited about is that it encourages home construction by aligning the opportunity zone incentive with the new markets tax credit, which typically has not been used for home ownership. As we've talked about many times in the past, I think opportunity zones is one of these tools that doesn't get enough attention on how much it has financed on rental housing. The Economic Innovation Group has released research recently documenting that there was almost 1 million rental units that have been financed in opportunity zones, of which at least 416,000 were, but for the opportunity zone, equity would not have been financed, according to that study. Very really impactful on how much that has done, but that's largely been rental housing. And it's not necessarily income and rent restricted like low-income housing tax credit. But as a lot of research has shown, the more supply you add to a particular market, the healthier that housing market is. It tends to have less rent growth, more affordable to a broader set of households when you have an adequate supply in a particular market. And a new markets tax credit, there's specific bars to using it, and the statute for rental housing can be to a limited extent, but it has been increasingly used for homeownership by some community development entities. And I think the administration is going to try to further advance those efforts with a new markets credit.
So I'm glad that you mentioned the new market tax credit and opportunity zones aspect of the executive order, because it is a prompt for me just to note that there is a large number of units of rental housing being built in opportunity zones that are build to rent units. So the concerns about the EO on limiting institutional ownership of single family homes, and it has the potential to be across purposes with the administration support of opportunity zones. So there is that build to rent overlap with opportunity zones, as well as noting it for historics and the law closing tax credit. And then the new market tax credit, as you noted, cannot be used for residential rental housing. It can be used for mixed use, where it's a portion residential and a portion non-residential rental use. So it has been used for some amount of rental housing, but the new market has also been used for sale single family homes. And that's where I do think the administration is going to start really pushing the use of the new market tax credit more broadly for sale single family homes. And we'll discuss more about that in a future podcast. I'm sure we have had prior podcasts on the use of new market tax credits for sale single family homes in local communities. With that said, we've covered a lot on the second of the three executive orders. Then the third executive order has to do with steps that various departments can take to expand access to credit and to make mortgage credit more affordable for homeowners, as well as those that are developing and owning and renting housing.
So that executive order does direct similar set of federal agencies, in particular, the Consumer Financial Protection Bureau, Federal Housing Finance Agency, the federal banking regulators, and actually, I'm sure you may consider on a future podcast talking about the bank capital regulations. So we already saw a pretty quick action there from the executive order to the release of those bank capital regulations that did incentivize the use of a bank's offering of mortgage credit. Many banks had stopped making mortgage loans and defer to various non-bank mortgage lenders. And I think this effort to reduce bank capital is going to help reduce that or redirect that trend. And I think that's something that was intended by that executive order. But beyond that, also to change appraisal standards, to modernize loan processing and other related actions there to try to reduce the cost. As you know, Mike, mortgage rates have gone up quite a bit since the pandemic, after them being very rock low. It's very, very low during the pandemic, and it is creating a lot of concern on affordability. It's the combination of housing prices going up, given the lack of supply, plus the impact of inflation on various other factors leading to mortgage rates going much higher than they used to be, is, I think, trying to get the administration to take action to make mortgage credit more available and more affordable. And we'll see beyond the bank capital regulations how the various federal agencies act on that. Like, before we move on, Mike, I want to actually emphasize one of the points you made previously.
Yes.
And that is, you mentioned opportunity zones and build to rent. One of the key benefits of the opportunity zone is a 10-year hold, which would be fundamentally undermined by forcing investors to sell within 7 years. That's very much in direct conflict with one of the key features of the opportunity zone incentives. So it's another example of how sometimes these executive orders might not be working perfectly in concert with each other.
We talked about build to rent, and or if you have what is considered a single family home and you're renting it out, some of the limits of institutional ownership and the like. We've also talked about the potential for the new market tax credit to be funding more single family home ownership and the efforts to potentially prioritize housing construction more generally in opportunity zones. What are some other aspects of the EOs that, if I'm a affordable housing developer, if I'm just a broader rental housing developer, if I am a state agency, what should I be thinking about with respect to what these EOs will mean to me in terms of my work in the coming weeks and months ahead?
It's a great question, Mike. And I will say, we had hoped that there would be more specifics, especially in that home construction executive order, addressing some key cross-cutting federal regulations like Davis-Bacon or the National Environmental Policy Act or the Build America, Buy America regulations. We didn't see that more explicitly, unfortunately, but there are some more broad directives there, and we'll be looking to see what actions HUD and other federal agencies take to lead to meaningfully reducing the cost of using federal programs in housing. I think there are a lot of things in the regulations and guidance that various federal agencies can take to help reduce the costs. And I think everything helps, right? Any way you can reduce the cost of building a unit of housing means more people can afford it. If the home prices come down, the rents come down. And so we'll see to what extent HUD effectuates this executive order, other federal agencies, to make those costs less. Furthermore, on the preservation angle, we want to look to see what actions does National Park Service, the Advisory Council on Historic Preservation take to streamline housing preservation regulations and guidance to make it easier to use those incentives to build housing. We've got a blog post up recently, Mike, that talks about this recent National Park Service Rutgers University set of reports showing that 2025 was a banner year for using historic credit for housing. And so hopefully that trend can continue and become even better this year and future years, given these actions by the federal government.
So I feel like we've talked a bit about the new market tax credit and for sale home ownership, but it was interesting to see it in the executive order. And in some ways, it was an echo of what was part of the announcement of the new market tax credit double round in December, which among its limited emphases of uses of the new market tax credit, there was a specific reference to for sale home ownership. How do you think this executive order will affect the use of new market tax credits for sale home ownership?
Yeah, we're very hopeful that the administration is going to take a look at the various friction points in both the Opportunity Zone and the new markets tax credit guidance that makes it difficult to use those incentives for particularly for sale housing, given that we've seen already very full use of the Opportunity Zones for rental housing. And there is as you mentioned already, Mike, our existing statutory bars for using new markets exclusively for rental housing. But I think on the for sale side, there are a number of things that our new markets tax credit working group has identified in regulations and guidance. And we're hopeful that this executive order will encourage the administration to take a second look and make changes. And with respect to opportunity zones, we've been asking a lot of guidance from Treasury on opportunity zones, not only to implement the new permanent iteration of the opportunity zone incentive, but also to take a second look at what they did the first time around.
Right.
We've learned all of how it's operated these past 8 or so years, and we want to make sure that we can improve upon that experience for the next 10 years. And with respect to using opportunity zones for home ownership, the key thing here is there are some barriers to using opportunity zone equity in existing businesses. And that is where I think if they make some changes, key changes to regulations, that will help facilitate the use of opportunity zones for sale housing and to incentivize more housing for home ownership. So we're looking to the administration to take action along those lines. And the Opportunity Zone Working Group is in the process of working on a comment letter focused on broader policy issues that touch on using opportunity zones for housing. And I wouldn't be surprised if New Markets has a similar effort ongoing. And in particular, I would say we are waiting with bated breath the 2026 round for New Markets credit. In the past, it's typically 2 months after an award round, which has already passed. But I think given some of the changes that the administration was considering and some of the various issues that were involved with the CDFI fund, this round opening was a little bit delayed, but I'm looking forward to seeing what's in there, in particular, what changes they're making to help facilitate using or incentivizing using the 2026 round for homeownership.
Excellent. So thank you for that discussion of the three executive orders. There's a lot more that we could be talking about with those, but I do want to shift gears now and discuss what might happen. The executive orders have happened and they take effect, and there will be various actions among the various departments that we'll be monitoring and commenting on. Now we're turning to the possible passage of a bipartisan housing bill. And as I mentioned, the Senate passed the 21st Century Road to Housing Act, blending the two individual bills into one name, and they've sent it to the House. Please discuss what's the process right now that we're in the middle of in terms of it getting enacted or not getting enacted. And then I want to spend our time focusing on the handful of the provisions that we think will most impact tax credit developers, opportunity zone investors, historic preservation, and use of new market tax credits.
Sure thing, Mike. And you outlined it already, the key milestones in the consideration of legislation. Schoolhouse Rock would suggest that we would have a House Senate conference to resolve the differences between the House passed and Senate passed versions of the legislation. But as I've learned over these many years, things don't always operate like Schoolhouse Rock says they will. For a variety of reasons, I won't get into the gory details on. I think many members of the Senate would rather not go to a House Senate conference. Ideally, they would just love the House to pass their version of the legislation. That does not appear very likely at the moment, but since one of two options really, or actually three, to be honest. One is the House just says we're going to pass again a different version of the legislation and put it back in the Senate's court. They could agree to a House Senate Conference Committee, which would then, resolve the differences. This has been used, for example, most recently on the National Defense Authorization Act you talked about. So it's not impossible, but it's not very often that you see that. Or the bill could die. It's certainly not a non-zero chance of that, much as we hope that's not the case. And the fact that we have all this attention on housing legislation, I think you need to step back a moment, Mike, and just note that it's not every day that you see a standalone housing bill pass at the House and Senate, albeit in different versions, but a standalone housing bill is so often we talk about it on this podcast. We need a vehicle, right, to try to take a particular housing proposal and attach it to a larger piece of legislation that's moving. This is the vehicle, which is sort of remarkable in that respect. And I think it's a testament to the fact that the Congress is hearing from their constituents about how housing affordability is a real concern. And so we potentially could be at the cusp of enacting the most significant piece of house legislation since Housing Opportunities Through Modernization Act, which was 10 years ago, and maybe even the Cranston-Gonzalez National Affordable Housing Act back in 1990. There have been similar comparisons. So it's exciting in some respects to see this attention, even if it's been a little frustrating this tail end prior to the process here, where things are a bit stymied. And we'll go over, I think, one particular legislation we're most excited about in a moment.
No, thank you for that. And just to make it clear for the audience, the House bill passed on a bipartisan basis. The Senate bill passed on a bipartisan basis. So it's an interesting situation in that both bills passed their respective houses on a bipartisan basis.
Strong votes too, right? 390 to 9 in the House,
Yep.
and 89 to 9 to 1 in the Senate. Those are votes you don't see every day.
No, and it reminds me of an old saying, and it's like Mark Twain, who knows who ever said it? Because it has its lore and all the rest, but reminds me of a popular story that you often hear where, in one of the versions I heard, was that a freshman Democrat had declared that a Republican across the aisle in the House was his enemy. And the House colleague told the freshman representative that Republicans are the opposition. The Senate is the enemy. So it's just interesting to see both the Democrats and the Republicans in the House having different aspects of the Senate passed bill that they're not in agreement with, and how they'll end up being able to resolve those differences remains to be seen. But with that said, we're not going to make any predictions about how quickly it could pass, other than saying that the longer it takes before, closer we get to November, the harder it is to pass given electoral politics. And it's certainly not beyond possibility that nothing happens between now and the election and it ends up being something like a lame duck session or something like that. At some level, I don't want to put that out in the universe. I don't want to manifest it.
Definitely.
But it's certainly in the range of possibilities. But let's focus on the parts of the bill that have potential to assist in the development of affordable rental housing, as well as investment in distressed communities through no market tax credits and or opportunity zones, as well as further historic preservation. And with that as a lead in, we could touch upon the parts of the bill that our listeners might be most interested in.
Sure thing, Mike. And this is it's a very comprehensive piece of legislation. There are over 40 provisions in it. So there's a lot in there. We could do a podcast purely on just that if we wanted to. But I'm just going to give a few highlights, the ones that we're most focused on, or we think will have the most impact on stakeholders you mentioned. First and foremost, of course, is the public welfare investment cap. Under current regulations, banks are able to invest up to 15% of their capital plus surplus in community development activities, which include affordable housing and new markets, tax credits, et cetera, and so forth. And while not every single bank is at their 15% cap, many are, and more maybe in the coming years as well. And as a further aside, the various bank capital regulations I mentioned could even potentially make that cap even more important if overall capital banks is lowered, lowering the denominator, so to speak. And that really is, I think, a key provision. It's in both the House and Senate bills. It's got lots of support in Congress, and it would meaningfully help increase investor demand for the low-income housing tax credit, especially among the sort of the mid-range banks or the super regional banks, where I think many of those are either at or approaching that 50%.
Right.
They documented that about 2/3 of the banks responding to the survey were hitting that level. So, sorry, you wanted to comment on it?
No, I just wanted to, the accountant in me wants to be a little bit more precise in the sense that the PWI is a cap you can't exceed, and banks can't get close to it. So no bank necessarily ever meets the cap because your capital is changing on a daily basis and all the rest. So it's not as if a bank will go up to the cap and hit the cap and then stop. As they approach the cap, they have to stop so that they ensure they don't go over the cap. And so the purpose of this is to go from an authorized max of 15% up to 20%. So there's more runway that banks would have before they reach the cap. And as you pointed out, I don't think the big national banks, as far as I know, there aren't any big national banks where the PWI cap is serving as a limitation, but there are a large number of mid-sized and other banks where the PWI cap is restricting the amount at the comfort level they have to make more community development investments. And I would also note that there'll be some state chartered banks and the like that would end up potentially having to have state regulations change and things of that nature. And if this does, I'll be optimistic when it passes and when it is increased, it is something that is a long period of time to impact the market in terms of 6 months, a year, things of that nature. It's not going to have an immediately strong impact, but it definitely is preventative and positive and directionally something that's well worth the investment time and energy to see that it is increased. That's all I wanted to say.
Fair enough. The other things I wanted to highlight is the legislation would eliminate the unit cap for the rental housing demonstration program. Recently, Congress did take action to make the rental assistance demonstration a permanent program, which was viewed very positively amongst many public housing agencies. But there still is this 455,000 unit cap on the amount of public housing that can be converted under the demonstration. And while I don't think we're imminently reaching that cap, it's again one of these things that will come. And it's great to have the flexibility such that that doesn't stop in the tracks, or demonstrations that would help preserve public housing and recapitalize public housing. And there was a recent study that we helped contribute to that by the stakeholders in the 10-year roadmap that found that there was a backlog of $169.1 billion in recapitalization needs for public housing. And so this would certainly be one tool to help address that. And so we're hopeful that will be included. The legislation. Sorry, go ahead.
No, go ahead. When you finish the rad cap, I wanted to comment.
Yeah, rad.
Okay. So I'll ask you after you finish one of your topics, you can pause. And if I have anything to say, I'll weigh in, or I'll say, keep going, Peter.
Okay.
I just wanted to note on the rad cap that years ago, I remember folks being very concerned that the capital needs of housing authorities and the fact that they could use rad in concert with private activity bonds to create capital to renovate, dilapidated public housing. And that, in essence, housing authorities would be like this vacuum vacuuming up all the bond cap in various states. And as such, other bond cap uses wouldn't be possible. That obviously didn't happen. In part, I think the various states had to balance their uses and the demands within their state. So the one thing with the lowering of the 50% test down to 25%, it's an opportunity to finance twice the housing. I do fully expect more housing authorities to be revisiting a RAD conversion now that access to productivity bonds may be more available in their given state. And as such, this unit cap, while looking in the rearview mirror, it seemed like it wasn't likely to be hit in the near term. If you go forward prospectively, I won't be surprised if some of those estimates are inaccurate and that you get there quicker because of the lowering of 50% test. But that's something that we'll see. I definitely know we're working with lots of clients that are now revving up RAD conversions based upon the lowering of the 50% test. On to the next item.
All right, Mike. Yes. So I'll be this very quick. The legislation does also provide flexibilities for HUD to increase the multifamily loan limits. There is a statute that has been relatively inflexible in these. And I think this portion of the legislation gives a lot more flexibility to allow HUD to update them as the markets need. So we're thankful to see that, because HUD financing is a key way, not just for RAD, but also outside of RAD with the low-income housing tax credits to be able to use FHA financing.
No, I definitely heard a number of clients reaching out, and they're pretty positively on this increase in loan limits. And it's one of those things that can fly under the radar, but getting those loan limits increased will make a difference in a large number of developments.
On the next provision, I just want to highlight there, the legislation does direct HUD to incentivize in HUD competitive programs, them to suggest that using those programs in opportunity zones should be a priority. And so one example of that, Mike, would be in the Choice Neighborhoods Initiative. We've seen really the successor to the Hope 6 initiative that was designed to comprehensively revitalize public housing and their surrounding communities. And so that's something that I think very much they want to align with opportunity zones.
Right.
And there are a number of other HUD programs where we can see that similar dynamic.
And to me, this highlights the reason why everyone in our audience should be looking at the states in which they develop and own properties and identifying the opportunity zones or the low-income communities, that's the zones eligible for opportunity zone designation, and be thinking about which areas they think it's best for the state to nominate. We have a on our website a map where you can go in and identify whether or not a given track is likely going to be eligible for nomination. And the nominations open up in July, and the governors have a period of time to make the nomination, and then they would go into effect January 1 of 2027. And even if you're working in these distressed communities and you're not raising capital through opportunity funds, there's definitely a benefit to identifying if it makes sense for the state to nominate a given census tract as an opportunity zone. If for no other reason, then there could be other program and financing and the like and grants and the like available because of that opportunity zone designation. So I would encourage our audience to be engaged in that nomination process. I think we all agree we want, of the eligible zones, we want the zone selected that can be the most impactful for a given state.
Absolutely. Those designations last for 10 years.
Exactly.
So change them a couple of years down the line. So it really puts decisions that are made now that are that much more impactful given how long they'll be in effect.
Thank you for emphasizing the 10-year term. So it's very impactful.
So the next provision I just wanted to highlight, and this is where we see the potential for a reduction in cost, is the home program is streamlined, and in particular looking at National Environmental Policy Act regulations, how it intersects with the home program. And just have a lot of other important statutory updates to how that program works. It is a key source of gap financing for low-income housing tax credit properties. And it was in need of an update in the statute. HUD had done a recent change to the regulations for home, but there's only so much you can do this way, and you really need to make some of the statutory updates, and this section of the bill does that, and hopefully will result in making it less expensive to access home funds for your housing property, among other reasons.
Excellent. Is
Last
there any
one
other
to highlight,
provision? Okay, go ahead.
It also does permanently authorize the Community Development Block Grant Disaster Recovery Program. And, we've seen this. We've seen huge disasters hit this country, from Katrina to the fires in Maui to Hurricane Helene. Each time, HUD has to create a whole new set of FISO regulations. It adds an extraordinary amount of time, complexity, and time is of the essence when it comes to disaster recovery. Having a permanently authorized common set of regulations that would more rapidly address, we're going to have, I'm sure, another big set of disasters in the coming years, and it'd be great to have a permanently authorized program to help address them, help with the recovery. And this is what this part of the legislation would do.
So thank you for that, Peter. I appreciate the overview of the bill, and you did a good job of describing the areas that are most relevant to our audience. If there are other parts, I'll speak to our audience for a second. If there are other parts of the housing bills, either what was in this House version that didn't make it into the Senate, or in the Senate version initially, but not in the final version the Senate passed, please share those with us so that we can be alert to it. If we're not already alert, obviously we didn't cover everything that we know here. So I don't want you to make a sort of prediction about the likelihood of passage or not passage of the bill, because I always feel like whatever percentages people get, you're never wrong, because it either does or doesn't. But maybe just discuss some of the issues in terms of the bill. I mentioned the bill is now, the Senate passed the bill. It's technically in the House's court. What are some of the issues the House has in terms of what's holding the bill up? And then we have a bit of a discussion about that.
In particular, I would say, Mike, of course, the build to rent provision in the investor ban section of legislation is a key component that's wholly up considered. Many housing industry organizations furiously lobbied the Senate as it was coming together rather quickly to try to change that. And I think that is contributing to a call amongst several key House members to push for a conference. There are other issues. Some House members were not happy that there are various provisions that was in the House passed bill wasn't included in the Senate and would like to push to get their provision included in it. Others were talking about this somewhat unrelated provision, really, on the central bank digital currency idea. And there's a temporary ban on that in the Senate bill. Some and the House want to make it permanent. Some don't like it at all. But I think there's a variety of these issues that are informing whether there will be a House Senate conference or not. And I'll just say it is really uncertain, right, as we sit now, as this podcast is being recorded. But I also do know that housing affordability is a key political issue. And I think it would be a tremendous missed opportunity for Congress on something that has such wide bipartisan support, generally speaking, to miss an opportunity and not demonstrate Congress can work on these type issues. And so I'm not going to give you a percentage, but I think there's certainly reasons to be somewhat optimistic that something might eventually come out at the end of this process, especially if President Trump weighs in. We've seen this in the past, whenever there's been a disagreement between the House and Senate, when the president gets engaged. And right now, his attention is elsewhere. To believe the war in Iran is obviously a key issue that's taking a lot of his attention. But if he engages and weighs in, that could change the dynamic fairly quickly. And you could see legislation get through to his desk, which I think, given all the good things we mentioned in there, would be a great thing for housing.
Excellent. Thank you, Peter. I think we did a good job of discussing both the executive orders and the status of the housing bill and made it as relevant as we could for our audience. Before I let you go, please share some other resources that you'd recommend our audience reach out to learn more.
I mentioned the working groups at the top. I'll reiterate those. We encourage you really want to stay engaged on these issues. Please consider joining, in particular on the housing realm. We do have the low income housing tax credit working group that doesn't only do the low income housing tax credit, but other issues that affect the housing credit. So like this legislation, for example, we talked about, encourage you to join that. We also do have our conference coming up at the beginning of May in San Diego on affordable housing, where we talk about all these issues. If you want to network with your fellow professionals and as well as get the latest, encourage you to register for that. And again, if there is a particular policy issue you want to engage us on, please feel free to contact me. As you said, my contact information will be in the show notes, and I'm more than happy to try to listen to your problem and see if we can find a solution.
Great. Thank you for that, Peter. And I know I'll see you before then, but I also look forward to seeing you in San Diego in May. And to our members of our audience, if you're in attendance, please take a moment to say hi to Peter and me. Thank you for being on the podcast, Peter. Do stick around for the off mic section. But before we go there, to the audience, now, if you haven't already, I say this every week, please subscribe to Tax Credit Tuesday on the platform you get your podcasts. Please also take a moment to like and comment on the episode. And please do share episodes of Tax Credit Tuesday with your colleagues. And if you have any questions you'd like to hear addressed on an upcoming episode, or more specifically, even topics that you would like us to cover, please contact us at contact@novocode.com. Okay, Peter, we've turned to the off mic section. And as having been on the podcast 25 times, even though when you first were on, I don't think we were doing this, we like to use this space to give a shout out to others working in the tax credit and tax incentive communities, and to highlight someone worthy of recognition. There are so many. Peter, to whom would you like to give a shout out?
And it's always a tough one because there are so many people that are deserving of recognition. But I guess I'd like to do my shout out for this podcast to a colleague who has really stepped up and gotten very involved here in the federal policy scene. And that is our colleague, Brad Elphick, who leads the New Markets Tax Credit Working Group, is a partner in the Atlanta Metro office of Novogradac. And he, in particular, recently participated in a panel at the Treasury Department talking about new markets and efforts to try to make it easier to use the new markets tax credit for homeownership. And he really was heavily involved in that event, working as a panelist, working on all the various proposals designed to try to reduce those friction points we talk about. So I definitely want to tip my hat to all of that work that Brad put into that and what he's going to continue to do in the coming weeks and months on new markets tax credit. We're very indebted to his work on that.
Great. Thank you for that. I echo your shout out. And that's another reason why folks should be joining the New Market Tax Credit Working Group. But also I encourage you to reach out to Brad on LinkedIn as well. Brad does a lot of postings on LinkedIn related to the New Market Tax Credit. And to that end, I encourage you to reach out to Peter and me on LinkedIn or Twitter as well. So thank you for being on the podcast today, Peter. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.